is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Markets tread water as investors await testimony from the Fed chair on Capitol Hill, while JPMorgan's Jamie Dimon says inflation is not beaten yet. Meta is said to be planning thousands more job cuts on top of the 13% reduction in November as a social media giant races to become more efficient. Plus, we discuss inflation and BOE policy in our exclusive interview with MPC member Catherine Mann. That's at 9:30 London time. Now, first thing is first, so let's check in on the markets. Now, I guess there are a lot of these markets are actually treading water. Have two key factors. First of all, what's going on with Jay Powell? There's 2 days of testimony that starts. I've had a lot of viewers writing in saying, get your popcorn ready, because it will be interesting to see how he navigates some of the questioning. And of course, Friday's monthly payrolls data could change everything. The other story we're continuing to watch very closely is what's happening in China with some of the key takeaways, of course, from the National People's Congress. European stocks for the moment getting to 0.8%. Again, it's quite fluid as we're also trying to figure out how Wall Street is looking at a U.S. default. And then if you look at the difference between a CAC 40 and a FTSE, for example, there's not that much on the screen. Now, JPMorgan Chief Executive Jamie Dimon says he sees the economy actually remaining inflationary. Well, he spoke to us exclusively.
We can still have a soft landing. A mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary.
Jamie Dimon speaking exclusively to Bloomberg's Ed Hammond on the sidelines of the JPMorgan Global High Yield and Leveraged Finance Conference in Miami. Now, across the Atlantic, ECB officials are divided over just how much to tighten. For more detail, our markets reporter Valerie Teitel joins us. Valerie, good morning. So the Hawks and the Doves squabble continues. What's the latest?
Yeah, it really was those comments from Holzman yesterday that the market is clinging onto. It was very, very hawkish, Francine. He called for 4 more 50 basis point hikes, which would implying a terminal rate of 4.5%. That is a lot higher than current market expectations, which are hovering around 4. He also sees the neutral rate at 4%, and the ECB's current depot rate is 2.5. That is implying that the ECB has a lot more to go. He also commented on QT, saying the pace should increase in the fall and include the pandemic emergency response program in those asset sales. We also heard from the Dove yesterday. That's Lane. He took a bit more dovish stance, saying we really need to look at the cumulative Titan effects. He's taking a quote out of the Fed's Brainerd's book right there. But he also warns against putting the policy on autopilot. He clearly doesn't want to promise too many of these jumbo 50 basis point hikes in a row without seeing the data come through. We also hear from another key Dove on Wednesday. That's Panetta. Watch his comments, and if it mirrors any of this pushback from the Hawks, this is all ahead of next Thursday's ECB meeting.
So how did the market handle the comments?
Oh, they clearly paid attention to those hawkish comments. We saw 2-year yields rising 10 basis points yesterday, and this stood out completely because treasuries are moving in the opposite direction. We've also seen a lot of sell-side analysts upgrade their calls for the ECB. That comes after the hot core inflation print yesterday, but also the whole last week, but also the Holzman comments yesterday. Nomura, Francine, is now calling for 4.25 terminal rate from the ECB, follows several others upgrading their terminal rate ECB calls to 4%.
Valerie, thanks so much. Valerie Teitel there with the very latest on the ECB. Now, later today, the focus, of course, moves to the U.S. Congress, where the Fed Chair Jay Powell set to testify before a Senate committee. It's a chance for Powell to signal how high he thinks rates need to go to tame inflation following hawkish comments from other Fed officials in recent weeks. Well, we're now joined by our Bloomberg equities reporter, Sagarika Jaisagana. Thank you so much for joining us, Sagarika. I mean, there's a lot going on. Of course, the equities are looking for the Fed to signal what they will do on interest rates, but really we have to understand inflation. What are equities telling us?
It's absolutely a big week, I think, for equity markets this week. First, with Jerome Powell's comments today and tomorrow, and then the jobs report later on Friday. As you know, equity markets have really been extremely sensitive to any signals around what the Fed is likely to do with rate hikes later this year. We had the big rally late last week when we saw when we had some comments that the Fed could consider a pause by the summer. I think sentiment has turned a bit cautious since then. So it all comes down to anything that Powell signals over the next 2 days about how high, as you said, he thinks rates would go. That could cause a lot of volatility.
So do the markets and actually do equities, do stocks worry more about a hike in interest rates than they do about a possible recession? I know we have a great Bloomberg piece also looking at why the jobs data in the U.S. could underestimate some of the labor data softening.
Absolutely. I think it's really interesting. Coming into the year, there was a big consensus among market strategists saying that, this year was going to be about recession and recession expectations and how that would drive equity markets. But we've seen over and over again that it comes down to inflation. It comes down to what the Fed signals that investors react to more. And certainly over the short-term outlook, I think there's a lot of divergence now in what strategists are expecting. We heard from Morgan Stanley's Michael Wilson, who is, of course, one of the staunchest, bearish voices on Wall Street. He said that the technical indicators now, the way that it's set up, could actually support the rally over the short term. Over the longer term, he remains a bear. And it's quite interesting because we have Wells Fargo's Chris Harvey on the other side, who said loud and clear yesterday, don't trade this like a bear market anymore because that's over. So I think March, at the end of March, once we have the jobs data, the latest inflation numbers, and then the big Fed meeting, of course, after that, investors are expecting to get some more clarity on how do you trade the rest of the year.
Yeah, the problem is that once the Fed starts talking about a possible recession, then it could be too late, right? Are there indicators in terms of stocks that specifically that we should be watching that almost advance what the Fed could say?
I think technology stocks, particularly in the U.S., are always a good example. We've had an outperformance in the NASDAQ recently. That's another indication, of the fact that they're focusing more on inflation. But cyclical sectors will also be key to watch because they have outperformed so far this year. And as soon as the recession fears sort of start coming back, they can be expected to, if they show underperformance, then that's a clear signal.
I think Warren Buffett also weighed in on share buybacks and what people thought about them. Is there a worry out there that actually companies feel so much pressure to give back to shareholders, either through share buybacks or dividends, that they're not really laying the foundation for future growth?
This is a story that we've been actually exploring since February, because again, through the earnings season, that was a standout, just how many buybacks we saw. It was a record start for the year for the US, strong start in Europe as well. So I think the indication that stock investors are sort of taking from that is that companies are still comfortable enough in the outlook that they see, the demand that they see, that they are able to announce huge programs.
All right, thank you so much for the great insight, Sagarika Jaisinghani there, of course, from Bloomberg Equities. Now, coming up, we'll talk a lot more about the economy. Also, a new book claims the relationship between consultancies and the way business and government are managed needs to change. So we focus on the consulting industry. We also focus on exactly how governments should be run. That's coming up shortly. Plus, later in the program, Bank of England MPC member Catherine Mann joins us. Don't miss that conversation on inflation and, of course, on her hawkish voting. 9:30 London time. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, there is an entrenched relationship, we all know it, about the consulting industry and the way business and government are managed today. That's a claim of a new book called The Big Con. It describes what it claims to be the confidence tricks that the consulting industry performs in contracts with hollowed out and risk-averse governments and shareholder value maximizing firms. Now, we're joined by one of the book's authors, Mariana Mazzucato, who is also professor of economics at University College London, actually one of my favorite people to interview. So thank you so much, Mariana, for joining us. Congratulations on the books. Everyone's outraged. People say, look, the firms say this is not true. But if this goes to the deeper problem about governments today, how are governments doing? Have they lost their North Star?
Yeah. So, well, first of all, the title is that we're all conned. It's not really about us versus them, the bad consultants versus the rest of the economy that somehow is trying to do good. We're saying that actually to tackle the most difficult challenges of our time, whether they're the ones around climate change, water, which is a huge crisis right now globally, health, so that we're actually more prepared for the next pandemic, and of course the digital divide. Just think what happened to all these students locked down in their homes globally who stopped having access to their human right to education. This requires huge amounts of investment, innovation, collaboration, collective intelligence, a word I increasingly love, between the public sector, the private sector, and civil society, including, by the way, labor unions. We should talk more about labor unions on your show.
Which we will.
And our book, the subtitle is How the Consulting Industry Has Infantilized Our Governments, Weakened Our businesses, and warped our economies. And the infantilization point is, it's a bit of a chicken and egg. As governments for the last 50 years have not only often cut their budgets in terms of the whole wave of austerity here and there, but they've especially cut their investment inside their own brain. They've outsourced that brain. They've outsourced that capacity and capability.
This is priorities, right? So this is the government and says, look, I don't know how to tackle that, so I go to a consultant. But is there a more fundamental problem? It is, but is there a more fundamental problem that actually governments don't know what they're trying to do or think about two short-term political cycles?
Yeah, well, first of all, we're talking about a sector, so the book is about the consulting sector, the industry. That is run on a business model that has a fundamental conflict of interest. When they are advising or consulting governments, there's no actual incentive to make that government more capable. Otherwise, you don't get the next contract. As though a therapist had a client in therapy their entire life, they're probably not a very good therapist. So there's a conflict of interest there. There's also a conflict of interest in terms of how the advising, the consulting is being done, often on both sides of the street, like advising both for ESCOM
Marianne, on the other side, if you're a government, why do you
exactly.
keep on doing this? So is there something fundamentally dysfunctional about most governments in why they're in this pattern on the government side?
Exactly. So I was sort of getting to that before, which is that it's a chicken and egg problem. If you stop investing within your brain, you actually then you become also addicted to others helping you. But remember how we learned how to ride a bike. We fell off that bike. If you're not doing, you're not learning by doing. So as the doing at the center of government is increasingly outsourced, government itself stops learning. Lord Agnew in the UK talked about this in terms of the infantilization of Whitehall after he saw the figures that were coming out of the UK in terms of how much the government spent on both COVID and Brexit. We were spending in the UK $1 million a day on Deloitte to do test and trace. Now, does Deloitte have expertise on test and trace? No, so it's not actually that surprising that they failed. Look at what then happened with the vaccine rollout. Government was capable. It used the National Health Service. It used the decentralized network of GP practices to roll out the vaccine.
Government is also too small. Right. How would you change government so that they can tackle this? Because, again, it's a chicken and an egg. It's like a vicious circle that keeps on repeating itself.
Yeah. So you have kindly invited me on for all my books. So The Entrepreneurial State, Value of Everything, Mission Economy, and all those 3 books that came before this one talked about exactly that. That if we have both this kind of wave of just obsessing about public deficits, which often actually increases debt to GDP, because if you're not investing in the denominator, the irony is even if the deficit is falling, debt to GDP rises. But also, if we don't actually invest within the civil service, have a creative bureaucracy, this is not about small versus large. You just asked about small. It's about smart. We need smart government. We need smart business and not an overly financialized one. You know, having spent over $1 trillion in share buybacks in the last year, over $6 trillion in the last decade, that means that we have a problem in the governance of the private sector, overly financialized, a problem in the governance of the public sector, thinking that at best it can fix market failures, and a very problematic relationship between the two.
So how do you fix that? Are we attracting the right people to government? And again, is everything too short term? I feel like we're in a very polarized world on every issue.
Well, one of the reasons I set up an institute at University College London called the Institute for Innovation and Public Purpose is precisely to tackle that. We need new education. We need a new mindset. We need new training within the civil service that is not just about new public management and public choice theory, which has, in the last 3 decades, brought efficiency metrics from the private sector into the public sector. So, and by the way, this actually started with Labor's third way, which is a bit counterintuitive. We like to blame neoliberals and conservatives for all the problems in government. This was actually a period where government was seen as useful, but we didn't actually think about for what. You know, what is the public purpose? Hence, what's the mission? And that requires metrics within government that is specific to government. So think what the BBC does with the notion of public value. I don't know any other public organization globally that is as rigorous about its internal metrics to hold it accountable as the BBC, which doesn't mean it's perfect. But this is really what I think that's needed to tackle all these problems which underlie the Sustainable Development Goals, 17 of them that the UN has set up. Every country has signed up to them. It will be impossible to tackle them without capable government, unfinancialized business, and a symbiotic relationship between the two. And the book actually looks also at the consultification of business, not just government. A lot of problematic and kind of difficult decisions that businesses are making, they prefer it to be rubber stamped by a consulting company, so it kind of goes down the throat of the board, as opposed to just taking ownership.
Mariana, we have so much more to talk about. Thank you so much, Mariana Mazzucato, co-author of The Big Con, of course, stays with us. Now, we also did contact the bid consultancy. They declined to be interviewed. We will, however, be speaking a little bit later this week to Tamsin Isaacson, the Chief Executive Officer of the Management Consultancy Association, for any industry rebuttal to claims in Mariana's book. We are also inviting government. That interview this Friday, 9:30 a.m. London time. Now, coming up shortly, the Bank of England MPC member Catherine Mann joins us. Don't miss that exclusive conversation, 9:30 London time. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, still with us, Mariana Mazzucato, professor of economics at University College London, with also this great new book talking about the big con. And this goes really to the purpose of government, Mariana. Here in the UK, we've had a turbulent, and that's probably a euphemism of the year, a turbulent 8 months in terms of, prime ministers changing hands and stuff. There's a big budget coming up. What do you want to see from the UK government?
Well, first of all, we need to get away from this dichotomy of it's either austerity or money because interest rates are low. The real question is, what do we actually need to do in the UK in terms of actually strengthening the social fabric, reducing inequality, having the greenest manufacturing sector in the world, having a digital services industry that actually supports that. And that requires investment. It requires investment from the public sector and the private sector. We were just talking about that and how they actually work together. And so the first thing is, let's not do the austerity mistake again. That's not going to help us. Brexit definitely hurt in terms of closing down the global market, which businesses need, which drive their expectations about investment. In fact, we continue to lag on investment figures, let alone the R&D figures. So we need a strong innovation system. So we need a government that actually supports an industrial strategy, an innovation strategy that's not just about R&D. It's about actually strengthening all those kinds of institutions that bring science and industry together. It means strengthening public education, right? We have this dichotomous private and public education in this country. It's public education that actually allows everyone to prosper.
Mariana, if you go back to, you're saying austerity is not the right way.
It never worked, it never will work.
But does the UK need to, does it feel like it needs to talk about austerity to get the markets back on track, basically, because of the wobble that we saw in the fall?
No, it's exactly the opposite. The reason that we got the wobble in the fall was because of this completely insane taxation announcement, right? So once they fixed that, the point was not then to kind of go even overboard and say, and we're not going to spend anything, we want to invest. Look at the countries globally that are leading. Look at what happened in Germany with green steel. That didn't just come out of the blue. It actually came from a public investment program. It came from loans that were provided from a state bank, conditional on the steel sector lowering its material content, which they did in both Germany and Sweden. In this country, I think one of the biggest problems is this very problematic public-private relationship, which is not actually conditional on investment together going towards the difficult challenges of our time. Just look with COVID, for example, we gave $600 million to EasyJet with no conditions attached. Very different from France, where the COVID-19 recovery to Renault and Air France was actually conditional on those companies committing to lowering their carbon emissions.
Is it because the UK government is less interventionist?
Well, by the way, once we got Brexit, we became quite desperate to attract capital. That is not a good, feeling of security in terms of your relationship with business. What you want to do is attract businesses to come to the UK because it's seen to be a leading hub of innovation and investment in different sectors. You don't attract them by just saying, oh, you will pay less tax here, or here's a deal, some sort of backroom deal. Those deals should be explicit, like, by the way, we've seen in the United States right now. We have, for example, a CHIPS Act, which is all about actually creating sovereignty in the United States with semiconductor chips, because currently they have a real problem that they're overly dependent on Asia. But that CHIPS Act, which has been designed by the Secretary of Commerce, Gina Raimondo, has different types of conditionalities, making sure that those companies have green supply chains, that they pay workers their proper wage, that they don't just use the profits generated from a public investment program for share buybacks. This is about a good symbiotic deal, not a parasitic
and a good
one.
governance. So I keep on being told that China will not mess it up because they also have the smartest brains working for the party, working for the states. Is there anything that the UK can actually learn from China? We're also following the National People's Congress very closely.
Interesting. Well, first of all, globally, the way to attract talent into government is actually to make it really ambitious and interesting to work in government. Think what happened after the financial crisis. While in Europe and the UK especially, we were doing austerity, the US had an $800 billion stimulus program, which was supposed to be green directed. And by doing that, they actually attracted a Nobel Prize winning physicist, energy physicist, to be the head of the Department of Energy, Steve Chu. Now, you don't attract a Nobel Prize winning physicist to be a civil servant by saying, come in and help us de-risk Elon Musk, come in and help us do our carbon taxes. It was about helping to steer the economy to be more sustainable, more inclusive, something that China, by the way, is spending over $3 trillion on. And some countries are able to actually benefit from China's attempt to massively lower its pollution. Denmark is the #1 provider of high-tech green digital services to the Chinese economy. That's a really interesting relationship, as opposed to fearing China, working with China on its green transition.
Thank you so much, Mariana Mazzucato. There was a good new book, The Big Con. This is Bloomberg. Markets tread water as investors await testimony from the Fed chair on Capitol Hill. JPMorgan's Dimon says inflation is not beaten yet. Meta is said to be planning thousands more job cuts on top of the 13% reduction in November as the social media giant races to become more efficient. Plus, we discuss inflation and BOE policy in our exclusive interview with MPC member Catherine Mann. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's go straight into that conversation. Well, traders are beginning to factor in a higher terminal rate from the Bank of England. That comes against a backdrop of UK inflation still above 10%. That looks like it has little chance of reaching the bank's target anytime soon. Well, let's bring in Catherine Mann, Bank of England Monetary Policy Committee member, joining us for an exclusive conversation. Thank you so much, Catherine Mann, for joining us.
I'm delighted to be here with you, Francine.
We've been wanting to speak to you for a while. Do you now feel vindicated? You were a lonely dissenter trying to push for more interest rate hikes last year. You were right.
Well, I think I was right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
So what's the right balance going forward? How do you see inflation? I mean, we try and predict what the Bank of England does, but actually this is about predicting inflation first.
Right. Well, so of course there are two elements. There's the external, the gas and the goods market prices that come from abroad. Those are on the downturn in terms of they're not going to be rising as fast as they did last year. On the other hand, the part that I've always been concerned about is the extent to which there is strong pricing power of firms. There is acceptance of those higher prices by a lot of consumers, of course not all, but even in the face of the cost of living crisis, there still are a lot of people out there who are willing to pay higher prices, and firms are willing to set those prices high.
So when are you expecting the bank to go back to that 2% inflation number?
Well, we have a forecast, and we have fan charts, and I'm in the upper part of the fan, both with regard to economic activity, but also with regard to inflation, especially core inflation. Now, of course, the bank's remit is headline inflation, but core inflation is where sustainable inflation at the 2% target has to be. So when I think about core inflation, I am concerned about this persistence, the embeddedness of the external shocks into core inflation, and both wages and, as I say, pricing power being a very important ingredient.
Catherine, how much more aggressive do you want the Bank of England to be to make sure that this doesn't get entrenched even more?
Well, I've had recent speeches where I've indicated that I thought more needed to be done in order to ensure that expectations in particular are for a declining rate of inflation and the embeddedness to be mitigated.
if you look at the terminal rate being
Right.
priced in by markets around 5%, will the Bank of England push back against that?
Well, the terminal rate is, I like to think of this as the terminal rate is sort of beyond the forecast horizon at this point. And so it's very important, the journey, not necessarily the destination.
Okay, talk to me about weak pound. How
Weak
much
pound,
does
yes.
that impact inflation?
Significantly. This is, the UK imports a lot of products. It's a small open economy. It is affected by capital flows as well as the sort of imported prices coming through the pound. And that is a very important ingredient. I did a speech middle of last year talking about spillovers, both with regard to imported prices, but also with regard to concerns about the stability of capital flows.
But if you look at the underlying condition, I guess, for a weak pound, I mean, there's
Right.
nothing really. Is there something that you can do, that the government can do?
Well, I don't make fiscal policy, so I'm not going to talk about that. But I think the real question right now is there has been quite a hawkish tone coming from the Federal Reserve. We'll hear a little bit more about that in due time. And, of course, from the ECB as well. The important question for me with regard to the pound is how much of that existing hawkish tone is already priced into the pound. If it's already priced in, then what we see is what we get. But if it's not completely priced in, then there could be depreciation pressure on the pound.
How much do you think is priced in?
They've been talking hawkish for a while, but I think perhaps there's more to go.
Talk to me a little bit about the housing market. So how much does the housing market, first of all, impact the psychology of consumers? Right. And again, this impacts the whole, the spending situation.
Well, there are a lot of different factors on the housing market that we need to consider, and we look very carefully, very disaggregated analysis on the housing market, who holds a mortgage, what the maturity of the mortgages are, when they were taken out, who's going to have to roll over at a 2-year horizon or a 5-year horizon, what the impact of that is on their potential spending power. We do a lot of that. Now, I think one of the important questions is what's about the wealth effect. So a lot of prices have, appreciated dramatically in the last couple of years. So there is some price depreciation, but it's really not much compared to how much prices on average appreciated over the last couple of years. So we have to take into account what the starting point was, as well as kind of the dynamics of the current pricing power.
But do you think at this point they have much further to fall, house prices?
Well, so we've seen a reduction in mortgage rates from the high point last fall. We see more competition in terms of products coming from various lenders. And so that suggests to me that there's more revival in process as opposed to a continued downward momentum.
What surprised you the most since you joined the MPC? And we'll talk maybe about how the meetings go. But in general, what surprised you the most about the UK economy? How resilient it's been, or the speed of inflation?
Well, actually, the concern that I have is something that I pointed out in the speech that I gave at the Lamfalussy conference in Hungary, and that is the supply side. And we did a supply stock take that we outlined in our monetary policy report for the February edition, and it really is striking how slow growth is in the UK. It's much slower than what we observe for the US or for the Euro area. And of course, you remember the old language of the speed limit that the central bank, well, the supply side sets the speed limit for how much the economy can grow without generating inflation. And so I really worry about the supply side of the UK economy.
But this is what also tied in with Brexit?
Well, I have commented on Brexit several times over the last year, indicating that that is a factor on the supply side, and I also believe it's a factor on pricing power.
But so it's nothing actually that will go away. Is there any, again, because of Brexit and the impact this has, how do you readjust to it? Does it make monetary policy much more complicated to say?
Well, as I say, the supply side and sort of a very lackluster supply growth does make monetary policy more complex and more complicated. Now, in terms of Brexit going forward, a lot of businesses have indicated that they've kind of managed a workaround. So the real concern is the uncertainty. Uncertainty plays into business investment, and of course business investment, as one of my colleagues, Jonathan Haskell, has said, is quite a bit lower than we would have expected based on sort of demand conditions alone.
What's it like being on the MPC? The relationship between the MPC and markets, I don't know whether that surprised you.
Well, having come from being chief economist at Citibank, I kind of knew about the relationship between central bankers and markets. We have a very, very robust market intelligence group, Andrew Hauser, Andrea Rosen, and so we get very, very good insights into market behavior. Now, I have, in my last speech, talked about the monetary policy transmission mechanism, have tried to focus on the role of financial markets in transmitting my decisions, or the monetary policy decisions, through the financial markets to the real economy, and thinking about that transmission mechanism and how robust it is and across the different dimensions of asset classes. This I think is a critical ingredient when we think about how tight monetary policy is, how much it has tightened. These are two different factors that affect how well monetary policy is transmitted to the real economy.
So do you also see the bank's role really in trying to guide markets? And is that relationship between guiding markets maybe sometimes a little bit too close?
You know, the too close is, I think it's very much a question. We would like the markets to be a transmitter of our monetary policy. And so in that sense, we are not going to be pushed by the markets. We have guided the markets when we think that they are on the wrong page. Last November, for example, when we thought that the yield curve was peaking at 5.25, and we thought that was inconsistent with what we thought our policy path would be. And at that point, we did have a very explicit message that was in the monetary policy statement. And the markets heard that, and there was some reaction associated with that.
Catherine, thank you so much. Catherine Mann, Bank of England MPC member, stays with us. We'll talk about the dot plot. If there was a dot plot for the MPC, what would Catherine's be? And we'll talk a little bit more maybe about QT, whether it should be used as a stability tool instead of a monetary policy tool. Plenty more ahead. This is Bloomberg. Let's continue our conversation, our exclusive conversation with Catherine Mann, Bank of England MPC member. Catherine, thank you so much for staying with us. Many questions, first of all, on how you view QT. QE, should it really still be a monetary policy tool, or would you scrap that and actually use that as a stability tool?
So it is a monetary policy tool, but it is in the background. I mean, we've been very clear to the markets exactly how much we plan to sell, the process by which we're selling it, and so it does have an effect on the monetary policy, monetary conditions. But our primary tool is the bank rate, and that's the way we view it.
Some of the things, if you look at the things that actually the bank wishes they understood more, I imagine it's why, some people are staying off the labor force. So they're not coming back to work, either because they feel maybe richer than they are, or long COVID. Right. How do you incentivize people to come back to work?
It's a real challenge. But what I worry about is that there are people who retired, I would say early, and 55 is sort of early, because there's a lot of your life left, and there's a challenge to making sure that your retirement savings are going to match your longevity. And so I worry that a couple of years down the line, we're going to see people trying to come back into the labor force, and that's going to be much more difficult. Now, we have seen just a little bit of an indication that the people who have taken sort of early retirement might be coming back for part-time positions. But it's early days on that, and as I say, I worry that people are going to find that their pensions are not sufficient for their preferred lifestyle and are going to want to come back. But
will they come back in a meaningful number to actually make a difference to employment?
Well, there are a lot of them who have left, and so I think you could see them come back. A meaningful number, perhaps not. There are other channels through which we would like to get more supply side on the labor side, educated graduates, that sort of thing on the younger end of the spectrum. That's also a key way of improving labor supply.
Are you surprised at the resilience of UK companies? And there's, the money is also going to U.S. companies because of the Inflation Reduction Act and other incentives. Yeah. How does that feel?
Well, there's we are sandwiched between two large geographic areas, both of whom are spending a lot of money on climate transition. The Inflation Reduction Act in the United States and Repower EU and Next Gen EU on the other side. It's important to be thinking about the implications for the supply side of the policies that are put into place.
But how do you see, I mean, there are two companies that could have listed here that also are listing elsewhere. Does that impact actually the strength of the economy longer term? So this is lack of investments, but also lack of capital.
Well, I think lack of investment is the side that I think is most important to be thinking about. In that regard, there's there's foreign direct investment, capital inflows can finance real side investment. So the listing issues are relevant, I think psychologically, importantly relevant. I think the underpinnings of why they are not listing here need to be analyzed. But from the standpoint of the supply side of the economy, business investment, innovation, that can be done with foreign capital flows or with domestic capital flows.
When you look at companies and the fact that they've been quite resilient, I mean, they have been very resilient. We haven't really seen that many defaults or zombie companies, despite interest rates going up by so much in such a short amount of time. Could that, come back to bite us later? Is there like a lag?
Well, I think we have to remember that there were a number of programs that were designed to support small and medium-sized business, and they have a different kind of term structure and repayment requirements because they were government backed. Now, for the larger companies, a lot of them took advantage of the low interest rates to put on a long-dated capital structure. So, in some sense, the interest rate increases that we've seen to date are not really hitting the economy. That's part of the monetary policy transmission mechanism that I've written about.
So the big question for the Fed is actually, does it crush the economy to get inflation to 2%?
Right.
Or does it change its target, or does it become more inventive in how it sees it?
Right. Well, the Fed is much more looking at using both tools, QT, the balance sheet, as well as the Fed funds rate as complementary tools, and they do work differently, just as QE worked differently when we were at the effective lower bound. So they are using those two much more actively than we are. One of the things about changing the target is it's a challenge when you change the target when you're below it. It's also probably a bigger challenge when you change the target when you're above it. I also think that when we think about the target, it's a number, but of course around that is, sometimes inflation is higher, sometimes it's lower, so there's a distribution. And one of the things that's important to think about is, what do the tails of those distributions look like? If you're heavy on the right tail, which means kind of above, and you have downward rigidities in prices in particular, and also wages, what that means is you're more likely to end up being above the target more of the time if you raise the target.
But so what's the right way to communicate to the markets on that?
Well, I think the markets know a lot about distributions, skews, and so forth, and I think communicating that way is a very good way to communicate to the markets.
And I was told that actually it's quite difficult for the Bank of England to do anything on targets, because it's almost a virility contest between the central banks. Do you see it that way?
Well, we don't choose our remit. It comes from Parliament, so they're the ones who have that contest.
So but is there an inventive way to not crush the economy, but also not reach 2% straight away?
Well, I don't think we're, as I say, our forecast has the headline reaching 2% because so much of the external dynamics are to deceleration. So it's more on the core inflation side that we're focused, or at least I'm focused.
You're enjoying your time?
Very much so, absolutely.
Okay, what's been the most surprising thing in meetings?
Well, very smart people. Very smart people and lots of different ways of looking at the same data. And I think that's a strength of the committee having, because otherwise you end up looking at things only in your own way, and having people around you challenge your views, I think, is a very constructive way to do monetary policy.
Catherine Mann, thank you so much for your time today. That was, of course, Catherine Mann, Bank of England Monetary Policy Committee member. Now, let's get straight to the Bloomberg First Word News. Here's Samuel Etienne. Hi, Etienne.
Good morning, Francine. China's new foreign minister has warned about growing tensions with the relationship with the US. At his first press briefing since taking office late last year, Qin Gang called Washington's approach towards Beijing, quote, a reckless gamble.
The U.S. claims that it seeks to outcompete China, but does not seek conflict. Yet, in reality, its so-called competition aims to contain and suppress China in all respects and get the two countries locked in a zero-sum game.
Strikes across France are disrupting transport today, with only 1 in 5 high-speed trains running and a third of Eurostar services cut. The Paris subway and commuter trains will be severely affected. The industrial action is part of an ongoing effort against President Emmanuel Macron's plan to raise the minimum retirement age. And Goldman Sachs is losing star stock trader Joe Montesano. Bloomberg understands the 46-year-old recently told the firm he's stepping down as head of equities trading for the Americas, but is yet to line up another job. Montesano has been key in Goldman's ascent to the #1 spot in equities for the past 2 years, with total pay that rivaled CEO David Solomon's. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg.
Etienne, thanks so much. Coming up, the Meta layoff saga continues with more staff said to be facing redundancy. More on that next, and this is Bloomberg. Bloomberg understands that Facebook parent Meta is planning to lay off thousands more people as soon as this week. Now, it follows November's cuts, where 11,000 workers lost their jobs. Now, let's get straight to Bloomberg's Berlin-based tech reporter Aggie Cantrell with the latest. Aggie, good morning. This will be the second round of cuts in 4 months. Was this a surprise?
So this time around, it probably wasn't a surprise. When the November cuts happened, it sent shockwaves through the tech company. In its 19-year history, it had never seen layoffs like the ones that were announced in November. However, this time around, this is all part of a bigger push for efficiency, for what Mark Zuckerberg himself has called the year of efficiency for the company, which has also been communicated in performance reviews at the company that only finished last week. And so there has been a sentiment of low morale and anxiety at Menlo Park, which has meant that a lot of people were expecting further cuts to come.
So what happens next, Aggie?
So what really happens next is that we look at what people are pushing investors for. What investors are pushing Meta for, which is essentially keeping on target for those cost efficiencies. And so what we're going to be seeing is essentially how Meta then goes on to strategize these cuts along with other projects that they have in order to save costs at the company. So, for instance, we've heard about their project of flattening, which essentially means buying out managers and cutting entire teams that they see as non-essential to the company. And so we're also expecting that these cuts that are expected to take place within the next week or so before Mark Zuckerberg goes on parental leave. And for investors, this is crucial for the company as it manages to persist with this cost restructuring going forward this year.
All right, Aggie, thanks so much. Great work there on the ground. Aggie Cantrell, our tech reporter based in Berlin. Now, there is quite a lot going on today. The focus firmly on 2 events later today, and then on Friday, the Jay Powell testimony that starts later on. And then, of course, Friday is the U.S. payrolls number. Investors pretty much sidelined before the Powell testimony. We're seeing also support by Quant, of course, highlighted after the S&P seems to be leaving the danger zone. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller in New York, Anna Edwards here in London, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York and 6 p.m. in Hong Kong. Our top stories today. Investors waiting to hear from Fed Chair Jerome Powell. Will he lay the groundwork for higher interest rates when he testifies on Capitol Hill? Meta Platforms isn't done with job cuts yet. Bloomberg's learned that the Facebook parent plans thousands more layoffs as soon as this week. And where do you find value in an uncertain environment? We will have an exclusive conversation with top credit investor Victor Khosla of Strategic Value Partners. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, we're all going to be focused on Jerome Powell, what he has to say, whether he wants to communicate any change in thinking to the market or not.
Yeah, it's all about the Fed, but it's also all about Washington. Look, we're coming into an environment where Washington really wants this no landing scenario, no recession at all. And Jerome Powell, really the burden of proof is on him, Anna. He has to say, well, look, we kind of need one to fight inflation. I think for that reason, you are starting to see futures perhaps have a little bit of a mixed picture. That brings me to our market check for this morning. Futures only higher by 0.2%. Anna, I would not call that conviction by any measure. You even saw that in yesterday's trading, some kind of hands off the wheel kind of action, autopilot almost. And it feels like that's kind of shifting over into today's session as well. The 10-year yield hovering at 392, only lower by 3 basis points. Again, it's those round numbers you really want to be watching. 4% on the 10-year yield, 40.50 on the S&P 500. Technicals are really going to come into play when you don't know what is coming next. NYMEX crude as well. I'm going to stick with the round number theory because an 80 handle on NYMEX crude, as we talk about a Chinese reopening, as we talk about just an acceleration in the economy that is lasting much longer than anyone expected, that's going to fuel the commodity complex. Right now, you're seeing it flat, but let's see how that changes as risk sentiment changes throughout the day as well. And we've got to talk about the dollar because, again, flat on the session. Anna, this screams uncertainty when it comes to Jerome Powell, but I want to go back to the overnight session because that's really where we saw a little bit more clarity what was going on over in Asia. Because if you look all in all with the MSCI Asia Pacific Index, you are going to see a little bit of a mixed picture, unchanged overall, but that's because China, Korea, the tech-heavy names underperformed, whereas the rest of Asia, think the Nifty 50 out of India, think the Nikkei, outperformed a little bit, but once again, no conviction, higher by only 0.3% on the Japanese index. But I want to go to the currency space because that's really where you see central banks dominating there. We're still at that band for the BOJ. Dollar yen trading at about a 135 handle. Again, nothing to write home about, but still important on that level, 135. The Aussie dollar is where all the action is. A dovish hike coming out of the RBA, and that actually sending the Aussie dollar weaker, down to the tune of about 0.8%. The question here is what kind of tone does that set for the Federal Reserve when there is still all this pressure for central banks to go higher, go be more hawkish, and hike for longer, Anna?
Yeah, interesting to see that downward pressure on the Aussie, moved yields, moved stocks. The talk there about whether they've reached peak inflation or not, of course, as we've seen in so many other geographies. Chrissy, if it's conviction you're looking for, you're not going to find that in Europe either. We seem fairly unconvinced of which direction we're heading in here. Some of these markets in positive territory, but the London market, the Spanish market, a little more lackluster. And if I tell you that utilities is the best performing sector in Europe, that kind of tells you quite a lot about whether we have a lot of conviction on going higher from here. We're waiting for Jerome Powell, essentially, waiting for that testimony a little bit later on, Chrissy. Let me show you some of the detail we've got going on here, though. I thought this was interesting. Interesting to note what's going on the yield curves right now as we head into what we're going to get from Jerome Powell. So we see these yields coming down in Europe, and this is in Germany, in France, and in other places from recent highs, of course. I talked to a guest earlier on who was talking about in the mornings how we're seeing in Europe quite a lot of appetite for bonds. In the afternoon, that tends to turn into indigestion, and we have seen so much supply from the European government and corporate debt markets over recent months since the start of this year. In fact, record-breaking supply. John Wood Group, this is a supplier to the oil and gas sector. That stock is up by 14.7%. They've received the fourth bid for the business from Apollo in the private equity space. They have turned it down for a fourth time. We'll see what happens there. Premier Foods, they make packaged foods, this business, and the stock is up by 9.6%. They're guiding higher, essentially. It seems they have some pricing power. So wherever it is that the cost of living squeeze is hitting here in the UK, it clearly hasn't dented our appetite for packaged cakes. And this is the natural gas price, up a fraction this morning. But really, I just wanted to point to these levels. 42 euros is where we trade per megawatt hour. Of course, we see Morgan Stanley bringing down their estimates for the second quarter of where we get to on natural gas. We also see the EU, Chrissy, talking about bringing together their collective muscle, if you like, when it comes to buying energy. From April, that's when we see that kicking in, which could be something to watch.
Yeah, really interesting stuff. The Premier Food story, Anna, is what catches my eye. I was recently introduced to packaged cakes, Jaffa cakes, I think they're called. They're interesting. I don't know how I feel about them. They're going to have to grow on me.
Right, well, we could get into a whole conversation about whether that is a cake or a biscuit, has tax implications, but let's not go there.
Yeah, bigger things perhaps weighing on the minds of investors and executives around the world. Economic risks, that is. JPMorgan CEO Jamie Dimon speaking exclusively to Bloomberg. Take a listen to what he had to say.
We can still have a soft landing. Mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary.
Well, investors perhaps getting a few more clues today when Chairman Powell testifies in front of Congress. Joining us now is Bloomberg's Valerie Teitel. Valerie, what are markets going to be looking out for? There's a lot to digest in 2 days of testimony.
Critty, it's going to be a big one today. I've got 3 questions I think the market's going to be asking to Powell. The first one, what is his view on the recent string of strong data? Does he view it as a one-off, or does he say something that it could be the start of a new trend? Does he endorse the terminal rates recent shift higher? Remember, we're now pricing above those dots that we got in December, near a 5.5 terminal rate versus the 5.1 median on those dots. Does he endorse that move as something he likes to see? And lastly, his tone on the disinflation progress so far. Remember, he used that word disinflation so many times when we heard from him last. I checked out that 71-page report that he submitted to the Senate before these hearings. That word disinflation didn't appear once.
Okay, so that will be really interesting. We will get our text counters out. There are tools on the Bloomberg to do that kind of thing, of course, to find out how many times he says that, if at all. Now, over to the ECB then, Valerie. Quite hawkish ECB comments, certainly coming from Holtzman yesterday. What were the takeaways?
These Holtzman comments really raised the bar for what the hawks are going to be pushing for next week. He called for 4 50 basis point hikes that would take the terminal rate to 4.5%. And then he said the most hawkish thing of all, that the restrictive policy stance doesn't start until they get above 4%. The current ECB depot rate is 2.5. That is implying the ECB has a long way to go. The market sure reacted to these comments yesterday. 2-year yields rose 10 basis points. The curve had some nasty bear flattening. The terminal rate has risen 60 basis points since the ECB last convened. We're seeing some very interesting trades being printed in Euribor options, betting on a 4% terminal rate by September. And the street has also been revising their calls higher. Nomura was the last one and the most hawkish. They revised their ECB terminal rate call to 4.25.
A lot to digest there. 4.25. Remember when we were talking about 4, 5, 6, the BOE, ECB, and then the Fed? And here we are, inching higher already. Bloomberg's Valerie Teitel, thank you as always for walking us through it. Well, as investors waiting around, trying to decide their next market move, what the trade is, their computer-driven counterparts, they don't have that luxury. Fast money quants are on a buying spree, just as the bond market creates fresh headaches for traditional money managers. Joining us now to walk us through it, Bloomberg's Justina Lee. Justina, the quants are buying stocks, but why? What do they see?
Well, by quants, we mean commodity trading advisors, and they're basically these trend-following futures trading quants. And what they look for are 2 things. I mean, one is price momentum, and we have seen the S&P 500 gain steadily over the past few sessions. And the other one is lower equity volatility, which essentially gives them the green light to follow that first signal. And now there is a lot of debate over, the influence of quants on the market. I have to put that out there. But if you believe in that, I think what it underscores are some of these virtuous cycle that tends to kind of get a trend going in the market.
Yeah, can this set some kind of, can it add to the momentum, and then raises questions about who really is in the driving seat, I suppose. But in terms of fundamental investors, they're not buying as readily as these CTAs that you referenced, Justina. So what are they worrying about?
Yeah, I think they're really in a wait-and-see mode right now. I mean, we have seen gains in equities partly because they have started and completed that repricing of a higher Fed funds rate. And so maybe the bar for an upside surprise is actually a bit lower now. But at the same time, I think after they're done worrying about inflation, which is certainly still at the top of their minds, there's also the question of fundamentals, as we have seen those earnings numbers slowing down.
Justina, thank you very much. Bloomberg's Justina Lee with the latest on that stock trading story. Now, Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. That follows a 13% reduction in headcount in November. Bloomberg's Alex Webb joins us now with details. Alex, why might Meta see the need for even more job cuts? Because this is not the first wave.
You look at the revenue per employee at Facebook and how that has evolved over the course of the past 4 years. It's actually seen its revenue per employee decline more than 90% of the S&P 500. At the end of last year, it had 87,000 employees. That was a 22% increase still on the previous year. So you could see, if you're management looking at that, say there's plenty of scope for more efficiency. It's bad news for employees, but it looks as though certainly they're going to be taking more out.
Alex, the year of efficiency, isn't that when Mark Zuckerberg coined 2023 for the social media platform? Back when he said that, markets were rising. The stock was soaring. It is again this morning, higher by about 1.7%. Is that going to be the message from here on out for Meta?
Yes, it's very much a change of tone. The company, over much of the past decade, hasn't really needed to worry about efficiencies. It's been growing at such a clip. That created a certain amount of bagginess when it came to the way the company was run. By putting out that message that now we are focusing on the bottom line, not just the top line, we have seen the stock rewarded. It had been trading at historic lows when it came to multiples of forward earnings. It's really recovered significantly in the past few months, and this is underscoring some of that. As you say, the stock is trading up in the pre-market. Investors clearly not disappointed in the least by the prospect of more job cuts.
OK, Alex, thanks very much. Alex Webb joining us there to talk about Meta and its efficiency drive. Coming up on this programme then, Victor Khosla joins us, founder and chief investments officer at Strategic Value Partners. We will get his take on where we are. Big macro themes to do with the part of the investment universe that he operates in. We'll talk about the companies he runs. We'll talk about other assets that they are exposed to in aviation, in real estate, a conversation not to miss. And Jamie Dimon, we will bring you part of our conversation there, weighing in on his top concerns in an exclusive interview with Bloomberg. More from that exclusive ahead.
The thing I worry the most about, if you go, is Ukraine. It's oil, gas, so the leadership of the world, and our relationship with China. I mean, that is much more serious than the economic vibrations we all have to deal with on a day-to-day basis.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. Now, Fed Chair Jerome Powell is set to testify in Congress today as markets await any commentary on how high rates can go and how long they stay at relatively elevated levels versus recent history, at least. Let's get an investor and business owner perspective. Joining us now, I'm pleased to say, Victor Khosla, founder and CIO of Strategic Value Partners, an opportunistic credit investor boasting majority control of some 15 businesses. So, Victor, good morning to you. Welcome to London. Thank you for coming in to talk to us. And so you bring us perspective as an investor, but also as somebody who sits, at the top table in these businesses and helps to operate them. So I wonder what your perspective is as we are ready to hear from Jerome Powell later on today about rates and how high they go and, crucially, how long they stay at those kinds of levels. Is this doing damage to the US corporate world that you see already?
It is. Rates are, as we look forward from here, we think rates are going to be higher for longer. And every time you say that, right, the world starts to look pretty foggy. It's hard to see, is it a shallow recession, deep recession, soft landing? These higher rates are causing enough kind of concerns out there. We think the world is foggy and tough. As we kind of look forward.
And can you give us any clues around how foggy, I suppose, given that you have majority control of some 15 businesses, so you're in those rooms trying to work out where these businesses are going. I mean, does it feel recessionary to you, or does it feel very, very different from that?
It does feel recessionary.
And that's not in the data, which is interesting.
Yeah, when we look at EBITDA, we look at cash flow, a lot of our businesses, and Anna, we are very much in the old economy businesses, in manufacturing, in industrials, in business services, and when we look at a lot of those businesses, we can see flattish EBITDA, we can see even declining EBITDA last year. And all that is, just pointing to kind of, the concerns. When we look at the order books going forward on a bunch of our businesses, some of them are having a very sharp recovery, like coming out of the airline crash. Travel's gone up. You're starting to see a real recovery take place. But that's kind of a one-off. And a lot of your industrial businesses, with raw material prices going up, labor costs going up, passing those through, there's a lot of indigestion as we kind of look at it.
OK, and you're here in Europe, and I mean, thinking about this higher rates environment and the damage being done perhaps to some businesses as a result, maybe that throws up some opportunities in your world. What is it that you're looking at in Europe that looks interesting in terms of opportunities?
Yeah, could I actually even step back for a moment, right? So we think what's happening today Normally, when you get one of these downdrafts, you get the central banks with a tailwind. They lower interest rates to kind of fight the economic slowdown, and they can't. They're fighting inflation. So for the first time in my career, I have been investing for about 30 odd years. Instead of the Fed or the ECB being your friend, they are creating kind of headwinds. So I think the first point I'd just take away from that is the world as we look forward is not so great because the interest rates have to go higher to fight inflation. The other thing we find is that China has been such a huge catalyst for global growth in the US, in Europe. With the US and China starting to pull apart a little bit, that catalyst is diluted.
Yeah.
Right? And by the way, Europe accounts for, I'm not just a visitor to Europe.
Yes.
It's 40% of our book, 40% of our investment team. And we think Europe is just in a more fragile position than even the United States.
Okay, more fragile here. Chrissy, jump in.
Yeah, Victor, you spoke of indigestion, you spoke of deglobalization. What does that mean then for the liquidity picture? Are you worried about that at all in the public or the private markets?
You know, right now, when you look at the way they are performing, you'd say, what liquidity issue, right? It is. The markets seem to be, especially for the most part, over the course of the last 6-7 weeks, they have done well. But we think you know, if you look at 2007, you had the bear stearns happen, and then the markets went on a tear after Bear Stearns and before Lehman. Please, I'm not trying to tell you that there is a Lehman moment, nothing like that as we kind of go forward, right? But markets can overreact. They can get a little bit giddy like they did in 2007. And to us, when we look at this new world with higher rates, with slower growth, liquidity is one of these fleeting things that can come and go. And we do worry about kind of what we have in store for us as we get into the second half.
Well, speaking of that second half story, I think it's widely known that private credit markets and lag the public market specifically. But if you start to see some of the bears in the public markets be proven right, to what extent are private markets really shielded from that, if at all?
Private markets are, they're in a much tougher place than what you might think of from the headlines, right? So the world we live in, so if you look at high yield spreads as a proxy, high yield spreads today are in the low 400s, basis point spreads to treasuries. But high yield today is much higher quality than it has ever been. There is more BB, which is the highest credit rating category of high yield out there. Much more of high yield debt is secured today than unsecured. When you adjust for it, it's not 415 basis point spreads. It's more like 550 basis point spreads. So if you just look at the private markets, you're looking at high yield spreads. They are telling you 415. That isn't quite right. And one more thought. As we look at high yield today, 20% of high yield debt is trading at a price below 80 cents, 80 cents of face. In tough times, like, you know, when we had COVID or when we had the oil and gas crash, that number is 30%. 30%. So on the face of it, you may think private markets are healthy, but when you adjust for some of the stuff I'm describing, there are more problems there even today than what meets the eye.
Well, Victor, I'm so glad you mentioned the high yield story specifically, because a good chunk of high yield is driven by oil prices as well. How concerned are you about, say, $100 oil when it comes to reflecting in those widening credit spreads?
You know, it is. Oil is always such a huge catalyst. What it does to electricity prices, right? For instance, especially in Europe where we are today, right? Electricity prices in Europe are a multiple of what they used to be pre the Ukraine invasion. You get oil and gas prices back to $100. It is a really large headwind. As you look at commodity prices, and electricity being the first place, you'll see that very direct impact here in Europe.
And something else that can be a catalyst towards some kind of distress then, Victor, I'm thinking here of the real estate market. There are pockets of Europe where we're seeing trouble in the real estate market, and there are warning signs perhaps in other geographies as well. Where in real estate are you concerned or see opportunities at the moment? There's a lot of talk about commercial mortgage-backed securities, CMBS. Are you in that space? What's your view on the sector?
The US is a little ahead of the repricing than Europe is, right? And look, we deal in both jurisdictions. We often find that to be true, Anna. So if in real estate, one of the biggest asset classes is office. New York accounts for a disproportionate amount of office CMBS, office debt. Vacancies in New York are 20% and climbing. When you look at kind of a whole bunch of debt which is coming due, when you have those underlying economic characteristics, like you can't rent your space out, we think you're about ready, in a slow motion way, you're about ready to start a cascade of restructurings in office space, right? Europe's a little further behind. It is, the vacancy in London is lower, but the same impact. It's coming through, right?
Okay.
And it's going to be multi-years.
Talking of cascades sounds worrying. I mean, we've seen what cascades in property markets can do in the past. Yeah. Are you thinking this gets that nasty?
We think parts of it, not all of it. There are some really interesting businesses in real estate, like the logistics business, the multifamily business. Higher interest rates are going to hurt, no question about that. But they don't have the underlying business dynamics of office property. And that makes office really separate. Office accounts for typically a third of all the debt out there. And cascade do worry, right? I would not. When I think about what is going to happening to the office market and what's coming, and it all comes, Anna, it doesn't come, it comes around debt maturing. Everybody hides until the debt...
Until they can't.
Until they can't, right? And those maturities are upon us. There are a couple of very noteworthy name brand deals in the US, which are just in the process of starting those restructuring discussions, and we think it's just the start.
Okay, Victor, thank you very much. I say thank you. A lot of food for thought. Thank you very much for joining us. Victor Khosla of Strategic Value Partners joining us here in London. Coming up on the programme, we will get an economist perspective on the world right now. Anna Stupnitska joins us, global macro economist at Fidelity International. We'll talk about what to expect from Powell. What will he say around the terminal rate? What will he say about the dots and whether they are stale? They are back from December, of course. The market has moved beyond them. So we'll focus on Powell and what he might say in the here and now. That conversation coming up shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Investors waiting to hear from Fed Chair Jerome Powell. Will he lay the groundwork for higher interest rates when he testifies on Capitol Hill? Meta Platforms isn't done with job cuts just yet. Bloomberg's learned that the Facebook parent plans thousands more layoffs as soon as this week. And Jamie Dimon's biggest concerns. In an exclusive interview, JPMorgan CEO tells Bloomberg what worries him the most when it comes to the global economy. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, we're all about waiting for Powell, waiting for him to speak, of course. Plenty more to come on that subject. Futures eking out some modest gains as we wait.
I think modest is the perfect word to describe it, Anna. You're not seeing a ton of conviction on this side of the Atlantic, especially in the pre-market trading. You know, futures higher by only about 0.2%. Nothing really to write home about. But I think one of the major stories that you have to watch here is simply the bond market. Remember, those round numbers really matter. 393 on the 10-year yield is where we're at. We're getting closer and closer to 4%. Last week, we were sustainably above it, only for a little bit of a technical pullback, only lower about 2 basis points this morning. But what happens if Chairman Powell really digs in his heels and said, look, we do need higher rates and we need them for longer. That's going to show up in that bond market. And the ripple effects aren't just going to be in the equity market. They're going to be in the commodity market and the FX market as well, which is why NYMEX crude is really important here. An 80 handle, which is really following, I think, risk sentiment here. Remember, just 30 minutes ago, we saw it in positive territory, now weaker by about 0.2%, and really not that affected by the dollar, which once again is kind of wavering, Anna, only stronger by 0.1%. That could all change in just a few hours, though.
Let's have a look at where we are on European markets then, Chrissy, and we are up by that's S&P futures still up by 0.2%. We'll scroll this over and show you what's going on European stocks in a moment. But broadly speaking, we are waiting for Powell, of course. There we are, up by 0.2%. So very similar, in fact, to the US futures picture. John Wood Group in focus. This is a oil services business. It's up by 14.5% this morning as they've received a fourth offer for the company from private equity, from Apollo it is, in fact. And for the fourth time, they've said no. They've turned that down. Premier Foods is also trading higher. This is a business that's upgraded guidance, a packaged food business, in fact. So it seems that some still have that pricing power despite difficulties supposedly for the consumer. And natural gas prices in focus, 42 euros a megawatt hour. We've seen Morgan Stanley bringing down their estimate of just how high those would be in the second quarter. We hear talk from the European Union as well, Chrissy, about combining forces, using their market flex, their market heft, if you like, to communally buy gas, and that's something that's going to be more of a feature of gas deals from April onwards. So certainly something to watch.
Yeah, it really is, and I think it's fascinating when you kind of tie the commodity picture to the economic picture, because this is something that we've kind of written off as a move lower. That disinflation, deflation eventually is really just a function of lower commodity prices around the world. But what if there's more to it? We should ask Anna Stupinitska, global macroeconomist at Fidelity International. She just joined us now from the London set. Anna, forgive me, I think I just messed up your last name, but nevertheless, we are thrilled to have you on. I want to start there with the commodity picture, though, and really pick up on the idea that if we start to see oil hit that $100 mark, which there seem to be tailwinds supporting that thesis, how bad are the ripple effects for the global economy?
I think we are clearly seeing the headline inflation rolling over now, and that is driven by commodities, by food prices, by base effects from last year. And so that is driving expectations as well, to some extent, inflation expectations. I think if we see a pickup in headline inflation again, there will be a lot of concern. Clearly, we are focused on core inflation, and that is very, very sticky. But if we also have headline picking up, if we have higher commodity prices, I think that will set even potentially more hawkish path from here from central banks.
Well, speaking of more hawkish, Anna, a big conversation, at least this side of the Atlantic, has really been a terminal rate of 6% or even higher. Over the weekend, Alan Blinder, who was the vice chair under Alan Greenspan over in the 1990s, had said, look, the market's getting ahead of themselves. Back in the 90s, you got to, the market was expecting 8%. They ultimately got to 6%. The market is overdoing it. Is 6% a viable number, in your opinion?
We think it is. Definitely the risks are skewed to the upside from where the dot plot is today and where the markets are pricing. We also think it's not just about the level, but perhaps more so, it's about the duration, how long the Fed will stay at that terminal rate. So it's about cumulative tightening. And so for the time being, we think that the Fed will probably revise the terminal rate up by 25 basis points for the time being. But I think if we see perhaps another inflation shock, as you say, oil prices, if we see inflation rolling over on the headline and sticky on the core, we might be looking at 6% ultimately.
Anna, good morning to you. What breaks in that scenario? If we have rates at 6%, or crucially to your point, not just at 6, but staying at 6 for a period. We just talked to Victor Khosla, who was telling us about concerns he has for the real estate sector, in particular in New York. I mean, where are you looking for cracks to emerge, I suppose, as we deal with these long and variable lags from the interest rate hikes we've already seen?
Yeah, well, I think the early cyclical sectors that are always the bellwether, of course, the property sector, that's one, and then auto sector, auto loans. So consumer-based credit would be one place to look at. And obviously, the areas that are more vague in the markets, and I think the policymakers are worried about, like private equity, private credit. I think this would be the first areas. But ultimately, we think that this huge cumulative tightening will feed into the real economy and show up everywhere and ultimately in the job market.
And does that only happen once individuals and businesses have worked, well, maybe individuals more, have worked through that stock of savings that they accumulated post-pandemic? Are we still sort of cushioned in our reaction to this Fed hiking by the fact that a lot of people, in aggregate at least, still have those savings to fall back on?
Yeah,
that was Jamie Dimon's point he was making.
That's right. It seems to us that the COVID-related excesses are still in the system. And this is perhaps why the transmission mechanism is a little bit lagged. And so far, if we look at the supply side, actually, it's interesting. If we look across the board and at various supply chain indicators, we have seen easing. Most of those indicators are back to pre-COVID levels or even easier. But the demand side is still very strong, partly due to excess savings, and we still have probably a few months for that to unwind.
Well, Anna, speaking of that unwind specifically, talk to us a little bit about the liquidity picture here. We've had market guest after market guest say, look, the liquidity issue isn't really one to worry about. But then when you look at kind of the ripple effects, how quickly could it become one if we start to see disinflation come much, much faster than expected like we did in the 80s?
I think we are already seeing that withdrawal of liquidity. And of course, somehow the quantitative tightening has been running in the background for the time being. But I think it will be more visible in the markets at some point. And I think we shouldn't forget the experience of the late 2018, where the Fed had to suspend the quantitative tightening program. And that is something, I think, one of the risks that we potentially face as liquidity might be drying up in coming months.
We've talked a lot about the Fed and the US, and that's understandable. We're going to hear from Jerome Powell today, Anna. But thinking about other news flow over the last 24 hours or so, China looms large on the agenda, talking about their 5% growth target, but also out with a host of changes to the way they're doing business at the moment, saying that they feel contained by US policy and pushing back against that. With all of that in mind, how do international investors look on that 5% growth target? The best ways to sort of access that as we live in a very changing geopolitical context?
Yeah, I think from a macro perspective, it's a good news, because we're not going to see that massive sugar rush again, like we saw on a number of occasions previously, that would feed systemic risks down the road. So I think it's actually good to target stability. It's good to target high quality of growth, and it's been consistent with the message for some time. Of course, how to access, there are different methods or different ways of accessing, of course, apart from direct ways. We know that Europe is very much exposed, and and hence actually the bounce in Europe that we're seeing now is probably partly driven by that China reopening.
Yeah, we often see some of those luxury names in Paris doing pretty well, and German industrials on the back of that. Anna, thank you very much. Anna Stupnitska of Fidelity International. Thanks to her for joining us on set here in London. Coming up, more from our exclusive interview with the JPMorgan CEO, Jamie Dimon. He certainly does talk about his view of the global economy, also the impact that stock of savings is still having in the US. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Mike Wilson, Chief US Equity Strategist at Morgan Stanley. That conversation, 8 a.m. in New York, 1 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. JPMorgan CEO Jamie Dimon says the US consumer is in, quote, great shape, and weighed in on the prospects of a soft landing for the US economy. He spoke exclusively to Bloomberg's Ed Hammond on the sidelines of the JPMorgan Global High Yield and Leveraged Finance Conference in Miami.
The consumer still has a lot more money in their checking accounts than before COVID. They're spending 10% more than last year, 40% more than pre-COVID, and it looks like they'll have excess money to spend roughly until the end of the year. And at that point, you can say, is it a little bit of a cliff? Is it a soft landing? And also, QT has now started to bite. That also is going to happen at one point, probably later this year, and that's when you're going to know what these things do. But we can still have a soft landing. The other thing about all this economic forecasting is Russia-Ukraine. I mean, that can change it dramatically and very, very quickly.
Do you think absent Russia-Ukraine, we will have a soft landing?
I think it's still possible, but I look at possibilities.
Likely or possible?
Possible. I think a mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary. Infrastructure spending, the IRA Act, lessening trade with certain parts of the world, bringing trade back into America. Those things are all. The green transition is going to take a lot of capital. So all those things kind of have inflationary attributes that are very different than we've been through the last 20 years.
I'm going to come back to the consumer point in a second, but last year you talked about in your letter this sort of confluence of three major factors: QT, America rebounding from a sort of post-COVID economy fairly strongly, and then obviously the war as well. You talked about them sort of leading us into an unprecedented period. How do we get out of that period?
It's diplomacy. I mean, that's why this is not, we always talk about uncertainty in the economy and the uncertainty. I call it normal uncertainty. The weather's, we know what the weather's like. That's why these things are different. QT, coming out of COVID, the war in Ukraine. I think it's been pushed out a little bit further. I would have thought we'd be dealing with this a little bit sooner, but it does look like some of that stuff is coming to fruition at the end of this year. Russia-Ukraine, we just simply don't know. I think it's wrong to sit and predict, because if you look at the history of wars, they've been pretty much unpredictable, and how they play out and which ones affect the global economy and how they do. If you look at a lot of wars, they didn't affect the global economy, but they were literally in very small parts of the economy. This is not in a small part of the economy. And this is a European nation. It's Russia, and it's oil and major oil and gas supply and food supply around the world. So this is a whole different attribute to it.
But then why does the consumer, particularly here in the US, remain, as you say, fairly bullish?
For over a period of time, their home price has been going up. Jobs are plentiful. Wages are going up at the lower end, which I think is a good thing. They've got a lot of money in their checking account. Stocks generally had gone up for 10 or 15 years. The consumer is, if you look at it today, in great shape. But I'm telling you, that's going to end at one point.
JPMorgan CEO Jamie Dimon there, speaking exclusively to Bloomberg in Miami. Global finance correspondent Sonali Bassey joins us now for a little bit more insight. What might just be going through the king of finance's brain a little bit. Sonali, we'll get to the geopolitics in a second, but Jamie Dimon has been a very outspoken supporter of the consumer, the American consumer specifically, but he's also had a lot of warnings. The economic hurricane comments, for example. Where's the word of caution this time around?
And he's not ruling out the possibility of a hard landing, even though he spoke a lot about a soft landing. Remember, I think what's important about what he said about the consumer was that even though they're in great shape, that they could face a potential cliff at the end of the year in terms of how they are saving and in terms of how the inflation might hit them at the end of the year. Why is this so important? It's because when you look at how investment bankers had come into this year, there was a hope that the second half of the year would start to clear up. But the fact that inflation is still so sticky, and you have Jamie Dimon saying that the Fed might have to do more at the end of the year, that's already starting. We're in March now. It's already starting to make the second half of the year a lot cloudier for a lot of Wall Street. The consumer cliff, the question that I would have is how steep does that cliff look? How much pain might they feel? He had a lot of words of optimism about the job market and even the wage increases across America. But again, that inflation picture at the end of the year is one question, as well as that diminishing of consumer savings. And remember, if you look also, the RBC Financial Conference starts today. We're going to hear from regional banks across the country as well that might have a different story to share about their consumers that might feel a little bit more strapped than what you're seeing from a JPMorgan consumer.
Yeah, and let's definitely not forget that, of course, Jamie Dimon was also the one who I think really kicked off the conversation on Wall Street about that 6% terminal rate, something that markets are now slowly inching their way through. I'm surprised that he wasn't more passionate about that level, something that I'm sure Chairman Powell will get a lot of questions about on Congress today.
Yeah, certainly. I mean, you look at JPMorgan, finally, we've been talking about this a lot. The consumer stocks are really coming back pretty this year. So the investment banks are really showing you that they're making more from lending than they have to pay out in deposits. That net interest margin is holding in pretty strong. But again, for a bank like JPMorgan, you are seeing the regionals have a very different story there.
And Shanali, so we heard from him about the banking landscape, about the U.S. economy, but also about some of the more global concerns he has. And clearly the impact of Ukraine is still with us from a market perspective daily. And indeed, he's watching China very closely.
He is watching China very closely, and that is certainly where the conversation is shifting. I think one thing that's interesting here, Anna, is when we think about how Jamie Dimon has talked about the cost of this war in terms of the global economy, he's talked a lot about the energy transition, a lot about it, and so has many of his peers on Wall Street. Think about Ken Griffin as well, who wrote a whole op-ed about energy security and the need for transitioning. But now another interesting thing that you hear Jamie Dimon really starting to bring up is the cost of globalization and potentially deglobalization and the rewriting of the trade rules. That is something I think that will start to become a bigger conversation this year in terms of what types of inflationary impacts it might have above and beyond what we're already seeing, to the point, the need for a higher terminal rate. I don't know that that fixes the rules of global trade.
Certainly something we're going to keep an eye on. Bloomberg's Shanali Bassick, we thank you as always. Coming up next on the show, we're live in Washington as Fed Chair Jerome Powell prepares to take center stage on Capitol Hill later today. Testimony in the Senate, followed by testimony in the House tomorrow. We're going to break it all down. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Let's take a look at what's coming up ahead today. Mass French strikes and protests resume against President Macron's pension reforms. Across the Atlantic, European Commission President Ursula von der Leyen is in Canada. She'll be meeting Prime Minister Justin Trudeau in Ottawa and holding a joint press conference later today. At 10 a.m. New York time, we'll have U.S. wholesale inventories data and the spotlight also on Congress as Fed Chair Jerome Powell presents his semi-annual monetary policy report to the Senate Banking Committee. And speaking of, we should get a little bit of a preview. A lot to watch for the markets, a lot to watch for economists alike. Let's get to Michael McKee, Bloomberg International Economics and Policy Correspondent in Washington, waking up bright and early for us this morning. Mike, a lot of pressure on this testimony. The expectation here is that Chairman Powell really has the burden of proof on him, that he has to establish that they are going to be going higher for longer. How likely is it that we get that message?
Oh, you're absolutely going to get that message. The question, Kriti, is how much detail will there be in the message? The problem for Jay Powell is we've got a number of key economic indicators that are going to come out after his testimony. We'll get the jobs report on Friday. We get the CPI numbers next week. So can he really specify where they're going if he doesn't know what those are going to tell us? Are we seeing some kind of a slowdown? I have a chart here that shows where economics, where the inflation rate is, and what Powell has to do is kind of close the gap between the yellow line and the blue line there. The yellow line is where the market thinks the Fed should be. The blue line is where the Fed is right now. So does the Fed go much higher? We're going to have to wait and see what Powell says, but I'm not sure we're going to get an answer as to whether we get as far up as the market thinks the Fed needs to be.
Yeah, I mean, even if he thinks that the dots are now a bit stale then, Mike, I mean, they date back to December, is that's not necessarily the kind of message he would be at liberty to give, is it?
Well, he could say that he thinks that perhaps the dots will move up. 5.1 was the consensus median in December, and most Fed officials have said they're going to get there. The question is, do they need to go above that? And would he say that they need to go above that yet? He's probably going to just say that they need to move higher because they still have 50 basis points to go to get there. So he can hedge his bets at the moment.
Well, Mike, Chairman Powell is no stranger to political pressure, and it feels like this time around a lot of politicians, a lot of congressmen might actually say, look, do we really need a recession? Do we need those widespread layoffs that I think a lot of Wall Street has been waiting for in terms of simply the health of the economy? What could Chairman Powell's message be to the people who are convinced we don't need a recession?
Well, he's He's convinced we don't need a recession. He has said that many times, but can he prevent one? That's the hard part about the Fed. They have only one blunt tool, and that's interest rates. And so he can't really say there won't be a recession, and he has said there will be pain. But it is going to be interesting to see how he answers people like Elizabeth Warren, the senator from Massachusetts, who's made a big deal out of this idea that we should not see recession, we should not see people thrown out of work. There may be some pain, he'll say, but he can also point to the unemployment rate now, which is at a decade's low.
Yeah, we will certainly look with interest at the political dimension of what he's going to talk about, Mike. What's the latest thinking on lags, long and variable as they are often described? And we've seen a lot of hiking from the Fed already. I keep seeing analyst notes that talk about the way that, US homeowners lock in long deals and corporates have locked in long deals when it comes to low interest rates. Does that mean that the lags are long this time?
Well, there are two aspects to lags, Anna. One is that the markets adjust interest rates much more quickly than they used to. They actually anticipate what the Fed's going to do and move up rates. But how often do you buy a home or a car? And how often do companies actually commit to major projects? It takes a while for the rate impact to hit the overall economy because these things are one-offs that take place over a period of time. So nobody really knows exactly where the level is at this point.
Yeah, and maybe that'll be a topic of conversation later on as well. Mike, thank you so much. Bloomberg's Mike McKee joining us there from Washington with a preview of what to expect from Jerome Powell as he speaks later. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.